3 months ago, I uploaded a video on Tesla claiming that the stock is only worth about $204 a share and that I won't be buying the stock as it has not fallen below my margin of safety price of $143 a share. Since then, the stock has rallied more than 80%, which meant that 1. I'm a terrible analyst, 2. I'm awful at timing the market, and 3. Quality companies like Tesla don't go on sale for long. I think at least one of them is true, and after doing further analysis of the company, I would like to give you an update of what I think about Tesla stock today. My name is Riyado and this channel is all about finding the companies of tomorrow, and in today's video, I will be covering Tesla's Q2 earnings results, my updated price target on the company, what I'll be doing with the stock, and more. With that said, let's go ahead and jump right into Tesla's Q2 results. Revenue for the quarter was $24.9 billion, which is up 47% year over year, and this strong growth is primarily due to increased vehicle deliveries and strength across all business segments despite lower average selling prices and currency exchange headwinds of $0.6 billion. Also, this is an acceleration from Q1's 24% growth, which is very impressive considering Tesla's larger size as a company. I've also included full year 2022 numbers up here just for reference. Breaking it down by segment, automotive revenue was $21.3 billion, which is up 46% year over year, and you can see that this is a re-acceleration from Q1's 18% growth, which again is very impressive. Keep in mind that automotive revenue includes sales from Tesla's full self-driving feature, which is already generating an annual run rate of over $1 billion of revenue. And with ongoing developments in robotaxis and increasing adoption of self-driving technologies, I won't be surprised if FSD revenue eventually makes up more than 10% of automotive revenue. And keep in mind that FSD is a subscription service, which means high margin recurring revenue for Tesla. That said, automotive revenue growth was primarily due to increases in vehicle production and deliveries. In Q2, Tesla produced close to 480,000 vehicles and delivered 466,000 vehicles, which is a year-over-year increase of 86% and 83% respectively. Again, this is a re-acceleration from Q1's growth, and this is due to strong demand as well as ongoing ramps on Tesla's gigafactories. Also, notice that growth is primarily driven by Tesla's more affordable line, namely the Model 3 and Y. And as you can see, Model Y production and delivery growth rates were much faster than Tesla's luxury line, which consists of the Model S and X, and this is expected as high interest rates decrease overall consumer affordability. In addition, you may have noticed that vehicle production and delivery growth rates are much higher than automotive revenue growth of just 46%, and this is probably due to the price cuts in recent quarters as the company aims to sell more vehicles and take market share. Well, Tesla's price cutting strategy is paying off as the company saw a surge in vehicle deliveries, which consequently led to an increase in market share for Tesla. As you can see, Tesla's market share in all major regions continue to improve sequentially despite the volatile market environment that we see today, which in essence shows strong execution and brand power as consumers favor Tesla cars over others. And this trend should continue for years to come as Tesla leads the charge in the EV space. Moving on, Tesla's services and other segment generated $2.2 billion of revenue, which is up 47% year over year. And as you can see, growth in this segment has been consistent with Tesla's automotive segment because as Tesla's fleet grow, more customers will be using Tesla's services such as supercharging. This table shows the growth of Tesla's EV network, which correlates with services and other revenue, and as the network expands, more customers will be utilizing these services. As you can see, the Tesla ecosystem is getting larger and stronger by the day with more locations, mobile service fleets, supercharger stations, and connectors added with each passing quarter. And one of the most groundbreaking developments in Q2 was that Tesla signed a deal with multiple car manufacturers, including Ford, GM, and Mercedes, to enable non-Tesla drivers access to Tesla's supercharger network, which will accelerate EV adoption and demand. This will not only increase EV sales, but also unlock massive revenue potential for Tesla's supercharger network. With that in mind, we can expect revenue from services and other segments to accelerate as soon as the supercharger network becomes available to other car producers, which is expected to go live in early 2024. Turning to Tesla Energy, Q2 revenue for the segment was $1.5 billion, which is up 74% year-over-year, driven by higher energy storage deployments, and as you can see, growth for the segment has been picking up over the last few quarters. But digging deeper, we can see that storage drove all the growth in Q2, with a 222% increase in storage deployed in Q2 due to the ongoing ramp of Tesla's first Megapack factory in Lathrop, California. On the other hand, solar deployments remained flat quarter-over-quarter but declined year-over-year by 38% as high interest rates slowed down the pace of solar installations nationwide. Homeowners and solar installers are adjusting to this high interest rate environment, and therefore demand should pick up again eventually, especially when the Fed begin cutting interest rates later this year or next year. That being said, I think Tesla Energy is the most underrated segment in the company. While everyone is talking about AI, superchargers, and the Cybertruck, Tesla's energy business is also growing rapidly, and yet it doesn't get the coverage and recognition it deserves. Tesla shareholders should be excited for the energy segment as it has so much more room for growth, which I believe is going to generate a lot of value for shareholders. That aside, Tesla continues to defy gravity. I mean, a lot of people were expecting Tesla to slow down in growth, but then Tesla comes out with another record-breaking quarter, which is a testament to the company's value proposition and execution. As we've seen in Q2 results, all three business segments are growing rapidly, and with strong competitive positioning and multiple megatrends in EVs, solar, and energy storage, Tesla's growth story remains intact as the company accelerates the world's transition to sustainable energy. However, growth comes at a cost, and Tesla is doing so by sacrificing profitability, at least in the short term. In Q2, Tesla generated $4.5 billion of gross profit, which is an 18% gross margin, and as you can see, gross margins have been declining over the last few quarters, which got many investors worried about Tesla's competitive positioning as the leading EV maker. This, of course, is due to lower average selling prices, which lowered overall margins. The other car manufacturers haven't reported earnings yet, but you can see that Tesla's gross margin, which is the purple line right here, has fallen below that of peers including Mercedes, Honda, and Volkswagen. This actually shows some weakness in Tesla's cost advantageous modes, so this is something to be aware of. But also keep in mind that Tesla is growing much more rapidly than peers and is ramping up production in its new gigafactories, so once production stabilizes, we could expect Tesla to gain economies of scale and subsequently see best-in-class gross margins once again. Besides, CEO Elon Musk mentioned that he is not concerned with profitability in the short term, and he is more interested in gaining as much market share as possible today. And one of the easiest ways to gain market share is to lower prices. As you can see, average selling prices have dropped more than $10,000 in a year, from about $57,000 in Q2 last year to just $46,000 in Q2 this year. At the same time, cost of production per car is also declining, although not as quickly as average selling prices, which is why gross margins per car has suffered over the last few quarters, as you can see right here, with a gross margin per car of about 19% as of Q2. But again, Tesla is sacrificing margins today to gain as much market share as possible, which in turn allows the company to one day collect high margin revenue through features like FSD. Moving on, let's look at gross margin by segment. Automotive gross margins, as you can see, has been trending downwards because of the price cuts, and on the other hand, gross margin for the energy generation and storage business is showing material improvement. As you can see, gross margin for Tesla Energy is about 18% in Q2, which is a 700 basis points improvement than Q2 last year, and it looks like Tesla Energy is going to overtake the automotive business and become the most profitable segment of the company. Similarly, services and other gross margin has also been improving as the segment achieves economies of scale through a larger Tesla fleet, and I won't be surprised if this segment surpasses automotive margins as well. That said, it's really great to see that profitability in the other two segments are improving, which help balance the declining automotive gross margins. Moving down the income statement, we can see how operating profit has trended over the last few quarters. In Q2, operating profit was $2.4 billion, which represents a 10% operating margin. Similar to what we've seen with gross margins, operating margins have been declining over the last few quarters due to lower ASPs, higher cost of production of 4680 battery cells, as well as increased expenses to fund other projects such as Cybertruck and AI. Again, Tesla is investing heavily for growth, and that's why margins are under pressure, but moving forward, operating margins should improve in the long run as Tesla gains operating leverage. But compared to peers, Tesla still has higher operating margins than most, although it has dipped below Mercedes-Benz, which has an operating margin of about 11%. Then again, Tesla is growing much faster than peers, and to have an operating margin profile in the upper end of its group is already very impressive. Finally, net income was $2.7 billion, which represents a net income margin of 11%. And notice that despite the price cuts and challenging macro environment, net income margin only dropped by 2 percentage points year over year, which reflects sustained profitability for the company. In addition, the main difference between Tesla and its competitors is that Tesla has very little debt, which means lower interest expenses and ultimately higher earnings for shareholders. So here you can see that Tesla has the highest net income margin in its peer group. So fundamentally speaking, Tesla is still the most profitable automaker in the world even after the price cuts, which means Tesla can still afford to cut prices further without really hurting its balance sheet. Overall, Tesla is sacrificing short-term profitability for long-term growth and value creation. By cutting prices, Tesla can drive higher sales and increase market share, which is management's current priority, and we can see that everything is going according to plan as seen from the surge in vehicle deliveries in Q2. With more Tesla cars in the hands of customers, Tesla can unlock massive value when it fully rolls out FSD, which is going to generate high margin revenue at little to no distribution costs. Unlike Tesla, competitors are operating on thin margins, which is why they can't afford to cut prices as much as Tesla. And I think management is making the right move in cutting prices. I think they're taking good advantage of the challenging macro environment that we're seeing today. And while competitors are being cautious, Tesla is being aggressive in taking market share, which I think is going to pay off in the long run. Turning to the balance sheet, as of Q2, Tesla has $23.1 billion of cash and short-term investments with $2.3 billion of total debt, which makes its net cash position to be about $20.7 billion. As mentioned, Tesla's main advantage is that it has very little to no debt, and as you can see, Tesla has a net debt balance of negative $20.7 billion, which means it has way more cash than debt. On the other hand, competitors such as Toyota, Volkswagen, and Ford are heavily indebted with more than $100 billion of net debt in their balance sheet, which is going to be a major growth limitation for these legacy automakers. At the same time, Tesla is continually decreasing its debt balance every quarter, which is going to further enhance financial flexibility and resiliency. In terms of cash flow, Tesla produced $1 billion of free cash flow in Q2, which represents a free cash flow margin of 4%. Also, free cash flow improved sequentially from Q1's 2% margin, so hopefully that trend continues where margins return to 10% plus as we've seen in previous quarters. Nonetheless, Tesla is the most capital efficient automaker today with an ROIC of more than 25%, and an ROIC of more than 20% is considered excellent, and for an automaker which has a capital heavy business model, that is extraordinary. So in my opinion, this chart alone should shut up any bearish argument against Tesla. With that being said, Tesla has a highly capital efficient business model with a strong balance sheet and cash flow, which gives the company a strong financial advantage over competitors. Turning to outlook, management don't really give any guidance but instead provided some rather vague production targets. For 2023, management expects to remain ahead of its long-term 50% CAGR target with around 1.8 million vehicles produced for the year. For context, Tesla produced around 920,000 vehicles in the first half of 2023, which leaves around 900,000 more vehicles that needs to be produced in order for the company to reach its target of 1.8 million vehicles. Cybertruck is also expected to begin initial production later this year in Gigafactory, Texas, so that is an important development that investors should keep an eye out on. During the earnings call, Elon did mention that Q3 production will be a little bit down due to temporary shutdowns for factory upgrades. However, Tesla should meet production targets this year, but keep in mind that this is production, not delivery, and hopefully Tesla is able to deliver around the same number of vehicles that it produces. And if we assume a 47,000 average selling price, 1.8 million vehicles delivered will translate to about $85 billion of revenue in 2023. Including Tesla Energy and its services and other segment, Tesla should surpass $100 billion of revenue in 2023. If we look at Seeking Alpha, we can see that analysts expect revenue to reach $100 billion as well, which is about a 23% year-over-year growth rate for the company. I think I'm feeling pretty neutral about this. I'm neither bearish or bullish on Tesla this year. On one side, vehicle production and deliveries look strong, but on the other hand, high interest rates could decrease demand for the remainder of the year. So I don't know, I feel pretty mixed about Tesla's outlook in 2023. But what do you think? Will Tesla hit $100 billion of revenue in 2023? Please let me know in the comment section down below. And while you're at it, don't forget to hit like and subscribe to my channel if you haven't done so, as it really supports my channel. But moving on, whether Tesla hits $100 billion of revenue or not, the long-term outlook of the company is still nice and bright. For one, according to Goldman Sachs, EVs are projected to make up half of global car sales by 2035. As you can see, EV sales are expected to accelerate as governments all over the world push for net zero carbon emissions. According to the report, EV sales will surge from 2 million units in 2020 to about 73 million units in 2040. In addition, global EV sales market share is expected to increase from 2% in 2020 to 61% by 2040, with some countries, including the US, reaching more than 80% market share. Put simply, the rise in EV adoption will be the single biggest tailwind for Tesla. And the company is capitalizing on this opportunity aggressively, with reports of further expanding production to meet with the rising demand, including an expansion to countries like Spain, Indonesia, and India. Furthermore, Tesla is expanding its EV lineup by introducing newer models, including the Semi, Roadster, and of course the Cybertruck, which is expected to begin initial production later this year. On that last point, pickup trucks are the most sold vehicles in the US, so the rollout of the Cybertruck will be one of the major catalysts for Tesla, as it will extend Tesla's revenue potential to pickup trucks. Fortunately, demand for the Cybertruck seems very strong, with about 1.7 million pre-orders as of January this year. It should be much higher today, and this pent-up demand should boost revenue once Cybertruck deliveries go live. And not forgetting to mention, Tesla is ramping up its full self-driving feature, and as you can see, cumulative miles driven with FSD beta is growing exponentially, with over 300 million miles of FSD data as of Q2. Being the largest and most advanced EV maker gives Tesla a massive advantage in terms of data collection, which is a crucial component to the success of developing the best self-driving technology in the market. And keep in mind that Tesla has the most vertically integrated technology stack with in-house data, software, and hardware, and this allows Tesla to deploy vehicle autonomy and robotaxis at scale, and I have no doubt that Tesla is leading the race today. Not only that, but Tesla also intends to license its FSD software and is already in discussion with other automakers, which means FSD will not be exclusive to Tesla vehicles, but may eventually be accessible to non-Tesla owners. So if Elon and company can execute, FSD rollout, FSD licensing, and robotaxis are going to unlock monumental value for Tesla shareholders. In other news, Tesla also opened its supercharger network to competitors such as Ford, GM, and Rivian, and this will not only accelerate EV adoption, but also significantly increased Tesla's revenue from supercharging. In addition, Tesla's energy generation and storage business should continue to experience robust demand. As you can see, based on a study by the IEA, solar PV installed power capacity is expected to become the largest source of electricity by 2027, overtaking other sources including wind, coal, and natural gas. In addition, according to Bloomberg New Energy Finance, energy storage installations are expected to grow at a 23% compounded annual growth rate, reaching annual additions of 88 gigawatts by 2030. So to put it all together, the outlook looks great for Tesla as the company leads the charge in renewable energy, supported by multiple mega trends in the sector including EVs, solar, and energy storage. Now let's take a look at valuation. So as mentioned at the start of the video, I covered Tesla about 3 months ago, back when the stock was trading at about $160 a share. And as you can see, the stock has rallied more than 80% since that video. With that being said, I want to give you my thoughts on the rally and what I think about Tesla's valuation today. Looking at Tesla's valuation multiple, we can see that the stock is still trading at the lower end of its historical valuation multiple despite the recent rally. As you can see, Tesla is trading at an EV to revenue multiple of about 8.8 times, which is slightly below its 5-year average of about 11 times. So by historical standards, Tesla stock looks slightly below fair value. But let's compare its valuation to that of peers. I've also included some big tech firms such as Nvidia, Microsoft, and Apple just for reference. Tesla's valuation multiple is the purple line right here, and as you can see, Tesla is trading at a PE ratio of about 76 times, which is way above its peer group, but way below Nvidia, which I think is not worth comparing to since it's in a bubble of its own. So at a quick glance, Tesla seems to be overvalued compared to peers and other big tech firms such as Apple and Microsoft. But Tesla trades at a premium for good reasons. First, the company is growing much faster than the auto industry and the S&P 500. And second, the company has much higher margins than the auto industry as a whole. So in my opinion, Tesla's valuation premium is well justified. But looking at Seeking Alpha, we can see that Wall Street as an average has a hold rating on the stock with more bulls than bears. As of today, Tesla has 11 strong buys, 19 holds, as well as 2 strong sells. However, the average analyst price target is about $237, which is about a 12% downside from current price levels. The stock has a street high of $350 a share and a street low of $85, which means that there's more downside than upside from the current price of $269 a share, so a slight pullback is very possible in my opinion. In my previous video, I also showed you my DCF analysis on Tesla, and I gotta say, I was wrong. In my previous DCF analysis, I underestimated Tesla's revenue growth potential, and I was expecting Tesla's revenue growth to decelerate to just 11% by the end of 2032. However, with recent developments about Tesla's supercharger network, FSD, Cybertruck, and the rapid growth of its energy business, I am revising its revenue numbers upwards, and I now expect Tesla to sustain higher growth rates through 2032 to 15% growth rate by 2032 instead of just 11% that I previously projected in my DCF model. So with that revision, I now expect Tesla to achieve almost $500 billion of revenue by 2032, whereas previously I was expecting a revenue figure of just $420 billion by 2032. With that being said, here's my updated DCF model and assumptions, and as mentioned earlier, I now expect revenue to reach nearly $500 billion by 2032. Next, I expect cost of revenue as a percentage of revenue to increase in 2023 as the company maintains lower average selling prices and then gradually improves over the years as price stabilizes. I also expect Tesla to enjoy higher margin revenue such as FSD and Tesla Energy, as well as economies of scale, which will eventually earn the company a gross margin of about 30% by 2032. Moving on, I expect operating expenses as a percentage of revenue to remain flat this year and then improve over time as the company gains operating leverage, eventually achieving 7% of revenue by 2032. Income tax expenses will eventually reach 20% of revenue, and as for depreciation and amortization, stock-based compensation, and capital expenditures, I expect them to drop as a percentage of revenue incrementally over the years, as you can see right here. And finally, for changes in net working capital, I'm going to set it at a constant rate of negative 1.3%, which is its 5-year average. So considering all this, I project a free cash flow margin of about 18% by 2032, which is higher than the auto industry but slightly lower than Apple's free cash flow margin of about 25%. So I think a long-term free cash flow margin of 18% for Tesla is quite reasonable. That said, assuming a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at an intrinsic value per share of $231 per share, which is roughly in line with analysts' average price target. However, my updated price target this time is actually about $30 more than my previous price target, and the big difference is due to the fact that 3 months ago, I underestimated Tesla's revenue projections, and therefore my fair value estimate at that time was too low. And so the increase in my fair value estimate today reflects my upward revision on Tesla's top line numbers. But even with the price target increase, I think Tesla stock is currently overvalued, as you can see right here, mostly due to the recent rally that we've seen. As such, I see a 14% downside potential for the stock based on the current price of about $269 a share. That said, I think there's just too much optimism baked into the stock price right now, leaving little room for error and no margin of safety, which is why I'm staying on the sidelines. But again, I could be wrong again. Before I wrap up the video, let's quickly talk about the major risks with investing in Tesla stock. First and foremost, we have competition. Yes, Tesla cars may be superior compared to peers, but competition is catching up. This includes pure EV startups like Rivian, as well as legacy automakers like Ford. That said, keep an eye out for automotive gross margins, and if it continues to fall, it's a strong indicator of rising competition as well as slowing demand for Tesla vehicles. The next risk, in my opinion, is distractions. I think we all know that CEO Elon Musk already has a lot on his plate. I mean, he's running multiple companies, but he's notorious for getting distracted way too easily. For example, Elon's Twitter takeover got a lot of investors worried, as it meant that he would have less time to devote on Tesla, which is probably one of the major reasons why the stock fell 50% or so in a matter of months last year. And recently, Elon challenged Meta CEO Mark Zuckerberg in a cage fight, and the first thing that came to my mind was Elon's health. What if Elon got hurt? Well, I hope it's a clean fight where no one got hurt, but keep in mind that Elon is 52 years old, while his opponent is only 39 years old, who is pretty active in the MMA community. So I leave the rest to your imagination. In conclusion, the investment thesis for Tesla remains intact. Tesla is the leader in sustainable energy, and it stands to benefit from multiple megatrends including EVs, autonomous driving, solar generation, energy storage, and AI. The company also has technology, brand, scale, and cost advantages moats, as well as a strong balance sheet. On the other hand, after looking at Q2 earnings results, I think investors should also be cautiously optimistic. First, margins are declining, which could mean rising competition as well as slowing demand for Tesla cars. And secondly, Tesla stock is already up 150% year to date. So I think the likelihood of a correction is very high in my opinion. These are reasons why I'm staying on the sidelines for now while I wait for a better entry point. But again, I could be wrong again, as I have in my previous analysis. But I'm sticking to my plan and invest only when there's a large margin of safety to my intrinsic value estimate. Besides, I think there are more attractive stocks out there, and if you're interested in what I've been buying, you can click in this video right here. Otherwise, that's all that I have for you today, and if you find value in this video, please leave a like, comment, and subscribe to my channel for more investment content. As always, I appreciate you guys for watching this video. I hope you have an amazing day. Thank you guys, and I'll see you guys on the next one.